Welcome to Compound Insights, a podcast by CFA Society New York. Today, we're speaking with Phyllis Costanza to talk about how finance and social and environmental issues are likely to change. Phyllis is the Chief Social Investment Officer at Advanced Portfolio Management's Social Investment Solutions Division, where she leads the development of social index and associated funds targeting companies which excel in both social impact and financial performance. Previously, Phyllis served as the global head of the social impact and CEO of UBS Optimus Foundation, where she launched the first development impact bond in India with Educate Girls, the first social success note in Uganda with Eunice Social Business and Rockefeller Foundation, and a blended finance investment product called the SDG Outcomes Fund. Prior to UBS, Phyllis was an executive director at the Children's Investment Fund Foundation and also worked in the public sector as the Manhattan representative to Governor Mario Cuomo. In addition, she is a board chair of Educate Girls USA, a member of the Council of Foreign Relations, and a senior advisor to Education Outcomes Fund for Africa and the Middle East. She holds a master's degree in public policy from Harvard University's John F. Kennedy School of Government and spent roughly 15 years of her career living overseas in places like Austria, Switzerland, and Ukraine. Welcome to the podcast.
Thanks for having me.
Our pleasure. First, wanted to start with, how do you see the recent global trends in sustainable investing changing or not?
Well, I think suffice it to say, it is going to change a lot. I think by this time next year, we're going to see a significantly different landscape related primarily, I would say, to ESG. I think that some of the changes we'll see will be instigated by the backlash in the United States. Although let's keep in mind that there's still an expectation that these funds, any sustainably linked funds, will still increase in size by next year to $34 trillion. However, in the U.S., because of the backlash and litigation fear, we will see fund closures, mergers, withdrawals. There have been significant fund closures in the U.S. in 2024, 71 ESG funds merged or closed, and only 10 new ones came to market, which is highly unusual. And 24 of them dropped their ESG-focused mandates. Now, this is the trend we're seeing in the U.S., but the majority of these funds, more than 80%, are held in Europe, and a very small portion in the U.S. and the rest of the world. So we will still see more money going into these funds in Europe and in other parts of the world where they're actually strengthening disclosure laws and renaming, but the regulations in Europe will have an impact as well.
Interesting. So how will ESG or impact-related investment funds adapt to this new environment? And do you foresee any key issues like materiality changing as a result of this?
Yeah, absolutely. We're going to see changes in materiality. And first of all, we look at materiality now by looking at financial materiality and double materiality, which looks at both significant social and environmental issues related to a corporation's performance and behaviors. And what we will see, I believe, is an increased focus on financial materiality. And companies are going to shift towards emphasizing this in their sustainability materials, et cetera. And there'll be a lot of more scrutiny on double materiality. I also think that companies and funds are going to have to justify their materiality statements, and because they'll have to counter this anti-ESG sentiment, They might have to prove with more robust evidence and data why certain ESG issues are considered material to the business. And then I think the third change we're going to see is a focus on short term versus long term materiality. ESG has really focused in the past on ensuring a company is addressing risks related to long term issues. And it was primarily focused on the environment. And I think we'll see an increased focus on the short term financial materiality of that. And we will see more scrutiny on these issues.
So, with everything you had just mentioned, how do you manage investments and philanthropic giving in these times of changes or volatility?
Yeah, this is very interesting times. Look around, and every company, every single day, we see another company saying that they're going to drop their DEI focus. We see impact investing funds being sued. Now, this has happened. This happened several years ago, but I think we'll see a lot more of that, particularly those that are focusing on certain populations. For instance, focusing on women or Black women or marginalized communities. We're going to have to justify all of that. That said, people who have been traditionally interested in this, their interest isn't waning. Morgan Stanley came out with a report that showed that they expect a 54% increase in their sustainability or impact related funds. And I actually met with some people over there recently who worked in their sustainability group who said that they're seeing an increase, especially in thematic funds. So people are coming in with an interest, number one, in climate, but also second is in social issues. And we have seen social issues have been largely ignored by ESG funds. And the reason for that is that because the S is so hard to quantify, there's bias involved in it, and it's qualitative oftentimes, so it's hard to assign a score or a numerical value to it. But because of large language models, we're now able to take all sorts of unstructured data and structure it in a way that will quantify it. So I think we will see more people focused on social issues, those who are already involved. And I think people will also, to manage this, they'll be probably shifting to more physical risks. So look at the wildfires, for example, in California. There will be a focus on utility companies making sure that they're resilient and ready for things like that. We're seeing an extraordinary number of rapid onset climate emergencies like wildfires, like floods. And unless utility lines are underground and protected from this, it's going to take a huge hit. These utility companies will take a huge hit. So I think considering some of those factors, a shift to short term, a focus on physical assets, and looking thematically also at social issues. And I think what will become more apparent is the changing nature of materiality. It is a dynamic concept. So, for example, right during COVID, after George Floyd was murdered, we saw a lot of attention given to companies to address racial issues and inequality. And for the expectation was that CEOs would actually come out and talk about racial issues. We have done a complete 180. There now, it is just unacceptable for CEOs to come out and speak on racial issues. So the materiality there is shifting. I mean, look at what happened with Bud Light. They featured a transgender influencer to celebrate her transition with Bud Light, and that did not go over well. They lost tens of billions of dollars because of it. So we see where we really will have to pay a lot of attention to how materiality is going to shift, especially when it comes to social factors.
So, earlier you spoke a little bit about some of the European markets and attitudes. What role, if any, do you see international trends playing in the growth of ESG investments?
So I think we are in the UK, well, in Europe right now, we are seeing increased mandatory adoption of new standards. So in the UK, there's mandatory adoption of ISSB standards. Australia is mandating new disclosures this year, and Hong Kong and Singapore are expecting to adopt this. And the EU is really leading the charge in this. However, in the EU, we're also seeing that pragmatism has to play out. And so while funds will need to comply with regulations, we might see that, and this is primarily to avoid greenwashing. I think we'll see funds change their names because if they have to fit into one of four categories, they may say, it's easier if we call it something else, like a Quant Plus strategy, and leave out any mention of sustainability or ESG. But the fact remains that looking at some of these critical issues is key to financial performance of a company. So I don't think investment firms are going to completely ignore them altogether because these are financially material. So they might not call it ESG, but they're definitely looking at it.
So, another aspect involved in this would be the philanthropic or giving side of things. So, with that in mind, given some of the recent news about freezes or possible freezes of US federal grants and loans, how does that possibly affect nonprofit organizations, their funding strategies, philanthropy?
The freeze on funding, in particular, the closure of USAID is taking a tremendous toll. And let's just forget about the nonprofits for a minute and focus on the human lives. You see organizations now that were delivering life-saving drugs like antiretroviral drugs. These people are no longer getting those treatments. There were a lot of studies being done where people were getting treatments where they needed to take a pill every single day. Those have just abruptly stopped, which will have lifelong impacts on people and will certainly affect their lives, and many people will die as a result. Also, vaccinations are not being distributed as broadly. So I think the impact we're going to see on people and organizations is that this will force, and some of it, frankly, is needed, it will force mergers and more consolidation in the nonprofit space. In the US alone, we have something like 1.6 million nonprofits. The vast majority of them are extremely small. And so there is room for some consolidation in this space, but this is a very crude way to achieve that goal. I think that funding will now shift also from philanthropists towards more efforts that are focused on saving lives.
I think you mentioned a little bit about the shift, but how, in other ways, have philanthropic strategies evolved in response to this?
So I think one of the biggest changes, and again, some of this is really necessary, is there will be a focus more on evidence of impact. And people who are giving money in an increasingly resource poor environment will need to prove that whatever they're doing is having a measurable impact on the people that they're supporting. And they're going to have to prove that. And again, with technology, it's a lot easier for organizations to find ways to demonstrate impact. And I think we'll see more organizations, perhaps more businesses that are coming out to transparently convey the impact that nonprofits and impact investing funds are having on society.
We mentioned a little bit, or you mentioned a little bit of it earlier. Given the headwinds, are clients, or have you been noticing that they are still interested in investing in impact funds? And what strategies can ESG or impact focused funds employ to maintain growth and attract new investors in a potentially less favorable, regulatory environment?
So I think that there's three ways that funds can maintain growth and attract investors. The first one is we are still are seeing an increase in demand for impact investing funds, particularly thematic funds. And talking to friends, former colleagues in wealth management firms, their clients are still asking for this. And their clients, not just here in the US, but their clients abroad as well. And they want certain themes and they want these things to be very specific to their desires. So, for example, probably the number one theme is the environment, and we're seeing an increase in that. The second, to my surprise, talking to a friend at one of the largest wealth management firms, the second requirement was around diversity issues. So they were looking at diverse fund managers, for example. And so I think a thematic theme will emerge. I also think demonstrating impact is going to be very important. I worked at UBS for 11 years and we surveyed our employees there. And the biggest issue they had was the lack of a clear definition around impact when it came to investing in, quote, impact related funds or impact funds. And also, while more than 90% of our clients were giving philanthropically, fewer than 20% of them were satisfied with their impact. So I think the second area is really demonstrating that these impact funds are really having an impact. And I still think, there's still room for concessional returns. We're still seeing clients who want to invest in funds that they know might not deliver market rate returns. And I think we'll see an increase in models like blended finance, where philanthropic capital is used in conjunction with investment capital, and that philanthropic capital aims to de-risk it. So I think those three areas, well, impact, thematic, and then, focus on the market that we know has been interested in this. And that market's not going away. The people who have been interested in impact remain interested in impact.
So does that tend to be more focused on the private wealth side or more on the institutional?
Great question. So I think institutions in the US, I think we'll see a lot of renaming of funds for them. So large pension funds, for example, are going to be under tremendous scrutiny. I think endowments, foundation endowments, university endowments will remain interested in this because their constituents, their stakeholders care about this deeply. And I think private wealth will continue to see a rise, as we have been, in wealth holders investing in impact solutions.
So we started off discussing global trends in sustainable investing and the changes that you see perhaps coming down the line. What do you see, if anything, changing for global trends in philanthropic giving?
I think that the private sector is having a moment now and has to step up to meet the need. And so we've seen thousands of organizations, millions of people affected by the closure of things like USAID. And what we are seeing is the private sector and civil society stepping in to help to fill the gap. So, for example, an organization is just emerged called the Foreign Aid Bridge Fund, and they are raising funds to deploy for life-saving interventions around the globe that are focusing on issues primarily, to start at least, around healthcare and emergency humanitarian relief. So I think the private sector needs to step up in this moment, and private individuals to help to address the most critical needs right now.
Great. Thank you very much. Thank you for being here, Phyllis. Thank you for listening to this week's podcast. This has been Compound Insights.